If you're looking to get a funded trading account, it's important that you partner up with a firm that is reputable. A firm that's led by a group of traders that have spent decades on trading floors and desks all around the globe. And it's important that when you take an assessment, you follow one with sensible rules that are easy to follow, that promote good risk management skills. Because ultimately as a trader, that's how you're going to succeed in the markets, is with good risk management. And also, you want to be surrounded by a community of traders and have tools at your disposal. And that's what ForexAnalytix is. So in the month of July, if you take a trader funding program assessment, you're going to get a 45-minute consultation with me, Blake Morrow, president of ForexAnalytix. And I'll spend 45 minutes with you one-on-one and talk you through the assessment process. So book your assessment today. I'd like to talk to you soon.
And Dana, welcome back to Face.
Thanks, Dale. Always great to be here.
Yeah, great to have you. We should probably just go to asking you what you're not long. That'd be short. We'd be able to, huh?
Let me think about that. That's a tough question.
Yeah, that's what I mean. So yeah. I know your style, and let's talk about what you're seeing.
To be honest, yeah. So, our niches, we're equity managers,
Yes.
and we are risk managers. So, first and foremost, we have a risk model, a risk overlay that takes a lot of input from market internals, breadth,
Right.
that type of thing that we've been running for decades, really since my father was a pioneer in that, what used to be called market timing, then active management, back since the 70s. So
your dad was in the biz, huh?
Oh yeah. And
that's interesting.
He started with Merrill Lynch back in the late 60s, just in time to hit the several bear markets in the 70s. And what he found out, what he realized pretty quickly was you have to be on the right side of the market, and find a way to be on the right side of the market, because Merrill Lynch didn't want him to be in and out. They wanted to be him and his clients to be in full time. But once you get bagged for a couple 50% losses, then you figure out a different way. So what we figured out was we want to be substantially long and aggressive when most of the stocks in the market are going up. Studies have shown about 70 to 80% of the direction of a stock is dictated by the direction of the overall market. So when the overall market's going higher, meaning a lot of participation, good breadth, then we want to be aggressively long, and vice versa. When the broad market is dropping, then we want to be defensive. And we saw some whiplash since we topped in April.
I wanted to ask you, so you're probably going to get to it, especially with what happened last week with the Russell coming out of the chute, gapping up, and the rotation coming out of some of the Mag 7. And, everyone's saying right now, I want your take on it. The problem with the market is it was too concentrated, too narrow.
Yeah, well, right into the move to April. This is the value line, geometric, which tracks the median stock in the market, and that the first quarter rally was really broad. It wasn't just the mega caps. Broad rally. Then last quarter we saw some whiplash, and really in the move from May, when you saw the mega caps and the S&P continue higher, we saw the broad market really start lagging, including a lot of the indicators that we look, some of our proprietary breadth stuff really started lagging and gave us some pause as to the durability of those new highs this time. In the large caps, unlike what we saw in the first quarter. That's changed over the last week or so. We saw that Thursday move, I think it was Thursday. that gap, and I didn't know if it was going to be something durable, but it's continued. And here we're looking at the NYSE AD line. So every major top in the history of the S&P has coincided with a divergence in the NYSE advanced decline line. So that move we saw into June, the new highs we saw into June and even early July. Um, we did not see a new high in the AD line. That's changed over the last week. You can see it broke out. Now we're seeing new highs there. So we've seen a vast improvement in breadth. It's not just the mega caps. Here's XLG, the mega cap, which continues higher. But we've seen a vast improvement in the internals, which to us means a lot. We were hedged. Here's the equal 8 S&P poised to break out. We were hedged in some of these lagging areas like the Russell, like Europe, which was lagging thanks to France. That has turned around at all as well. Here's the stock 600 in Europe, which has rebounded, also looks poised to potentially break above that 127 and join the party again. So the internals of breadth is back on the right side. We've dropped our hedges. And to your question, what are we not long? Nothing. We're not short anything right now. Back in pretty much full on bullish mode. Still legging into some further positions, further allocations, but hedges are off right now. I guess
I'm curious, what were you using for hedges?
For hedges, we use mostly ETFs for our clients. So we use our inverse ETFs, and they're not buy and hold instruments, but our philosophy, our methodology is not a buy and hold one anyway. So we use the inverse ETFs, whether it's inverse Russell, we had an inverse, a couple inverse international funds, the EFA, Europe. We were short the semiconductors off of that the major top that we saw briefly before quickly realizing that was wrong as well. So, but those are the instruments that we use. The only hedge we have right now, I heard you guys talking about the VIX, was this little pop yesterday above the 50-day. So we are long the VIX, which is kind of our only hedge right now. That opens up upside to the mid 14s anyway right now. But as far as equity sectors, we're not short anything right now.
Okay. Do you think, Jamie, I'm sorry, do you think that we could have Dana, we have a hook here that although, the market was performing like a superstar with narrowing breadth, is the broadening out, could we broaden out and yet have those averages that are broadening out not be able to carry the day if what people are coming out of, like the Mag 7, they're what led the market there.
Yeah.
Can the Russell carry the day if we have pressure in mega cap?
Right now, it looks like there's rotation out of that. And I also heard you guys talking about, maybe a technical reason why we pause here in or rotate out of some of that mag stuff, some of the large caps, the most consequential fib extension levels in the market here are that 161 extension from the 2022 on the S&P, which we ran right into. And it's all the large cap growth stuff that's hitting those extensions. And it's not just the S&P. We got the NASDAQ 100 hitting to a T. Yeah, the 161. You got the Russell 1000 growth hitting right off of there. So you've got here's the 161. You've got a good technical reason for some money to come out of there, at least temporarily. But the fact that we see a resurgence in breadth in the broader market is to us, a telling sign that money still wants to go somewhere
Yeah.
within the equity market. And how durable, how long lasting that will be, I don't know. But we operate mostly in what we call the intermediate term time frame, which is, 2 to 6 months. So over that time frame, we're a lot more constructive now than we were maybe a couple weeks ago. Here's the semiconductor ETF SMH, which also
It's
ran into that
diverging.
261 extension. So gives you a reason to maybe suspect a little bit of a pause or slowing down in those former leaders, but enough sectors are working are starting to work again, including international markets, that there are enough places to rotate into attractive places that I think this thing can continue here, at least in the near term.
Okay. Any comment on the fact that like the 10-year would be a breakdown under 420? I've been looking. I think we could trade well under 4. And at the same time, we're coming out of the inversion and beginning to steepen a little bit. What does that mean to you?
Yeah, well, first, just technically, around that 4% is a massive level for yields. We think we're of the mind that yields hit
That was it.
a
Yeah.
long-term bottom during COVID. That 60-year cycle of interest rates probably bottomed then. So that means we're moving higher for, the next several decades.
But could we go to 3% first before we
Yeah,
have another wave?
of course. I mean, you have all these huge, what doesn't look huge, but some of these moves are huge within that longer term trend. So nothing moves in a
Yeah.
straight line. You'd see that first major fib retracement level from the peak in the early 80s, as well as some other junctures along the way, is around that 4% level. So
Yeah.
that's the line in the sand for us right now. Really, maybe that 23 retracement from the bottom to uh, the top last fall is around 390. So I think we're
Okay.
gearing up for a major test around 390. And to your point, I think we could certainly we've been buying bonds. We're long 30 and
TLT.
10-year. Yeah.
Okay.
Well,
Yeah.
a
Shorter on the curve,
leverage
10-year.
version of it. No, 30 and the 10-year.
Okay.
390, I think, is we're gearing up for a big test there.
Yeah.
I think that level could easily give way, and then
Yeah.
now we're looking at about 3.25 would be
Yeah.
probably the next major test. But yeah, I'm
So
of
when
that
does the
mind.
market, so the market's going to celebrate this, right? And, lower yields, risk on,
I would
etc.
I would believe so, unless
Okay.
it's
When's it
due
going to,
to
when
some
would it wake
catastrophic
up
event.
when will it wake up to the fact that rates are coming down because there's economic weakness? If we had bad earnings?
Uh, Yeah, some fundamental reason for that, some shocking fundamental catalyst, I guess, which
Yeah.
we don't even include in our models because
Yeah.
you can get such a disparity or divergence between economic and market factors that it doesn't move the needle for us. You could be following fundamental factors and be wrong in the equity market for years on end, and that does no help for us or for our clients. So
Yeah.
that certainly could lead. It would be significant lead time where you're scratching your head asking, well, why are yields so weak? Before
Yeah.
eventually you figure it out. It could be months and months down the road. So I don't worry about that. As you know, we worry about price action and
Right.
actual objective market data that's coming from within. So we're happy to be long bonds and stocks, at least as long as they're going in the right direction.
You made a great call 3 months ago when people were very worried about the Nikkei. And even though European bourses haven't yet made new highs, the Nikkei skied again. So that was a great call, Dana.
Yeah, well, Japan.
Are you surprised I remember?
Well, no, you're the OG, so I'm never surprised by your calls, and you're more accurate than most anyone that I know. So never
But I
surprised
remember
by.
your stuff. Yeah, so that
Okay,
was a
no, I appreciate that.
great call.
Well, the Nikkei, yeah, people were concerned that we're hitting those all-time highs, which, by the way, happened pretty quickly because not many people were on the Nikkei until maybe over the last year or so when
Right.
we're, most of the way off those lows. But I think the Nikkei's got a lot more fuel to it.
Okay.
Certainly it could use some digestion for a while, but the thing that's kept us mostly in Japan has been the hedged equity fund. So this is DXJ, which hedges, of course, the
Yeah.
yen,
Yeah.
which is another way to
Wow.
play Japanese equities. And I mean, there's almost been not even a pause in this
Yeah.
move. So we've been in here for a couple of years and still skyrocketing higher, which tells us a lot, I think, about the yen without directly looking at the yen. So this is another good way to play Japanese equities as long as this trend is higher, which it is. It's hard to chase, obviously,
Yeah.
something when it's so extended, but obviously the trend is still higher and
I'd be
given.
careful that, if we get one more high in the end towards 164,
Okay,
that's going to complete a pattern up
okay,
there in the end. So there could be one more hurrah,
yeah,
and maybe you don't want to be hedged on the end. Maybe you find another
gotcha.
way to play
Yeah.
Japan. Just, I'm a professional guesser. So anyway, how about the miners? They've actually begun to outperform gold, which I haven't seen in, I don't know, a long time, 5 years, 10 years.
Right, it's been a
Um,
while.
yeah, so
Um,
do you like it?
we do. We've liked the precious metals complex for some time since it's been we had that ma massive rally in gold
Yeah,
into 2020, which really and gold really brought it up to the all-time highs from 2011. Since then moved sideways. I don't have the gold or GLD chart up, but it's really been a massive cup and handle. It looks like
yeah,
forming. So there's a lot of potential fuel left there for
yeah.
further move to new highs. At the same
Well,
time, GDX, that big rally up into 2020, brought it right up to the 61 retracement of that down move. So to your
yeah,
point that it's been lagging the miner's been lagging the metals for a while. That's certainly been the point, but we've seen some catch up of late,
yeah,
which is
yeah,
always a good sign. It's kind of a miners, as you know, have often been a higher beta move on those metals. So as the metals kind of digest their moves, the miners have been
yeah.
catching up. So we do
They're
like that
printing
potential
money
here.
now.
Yeah, we
Yeah.
do like that. GDX would not take much for it to get back up to that 46
I,
level.
I'm looking
Um,
for 70. If you take the COVID low, Jamie, and draw a line, that chart you have up, it's fine.
yeah.
You draw the line off the COVID low and then the low in 2022,
Okay.
and then you draw the line off the high in 2020 and the high in 2022. It's
Okay.
a symmetrical triangle that measures $40. So breaking out over here, at 38 or 40, it measures 70 back to the highs of 2011.
Honestly, wouldn't surprise me, especially given the magnitude of the breakout we've seen in gold itself. Um, Also silver.
How
Another,
about throwing a weak dollar on top of it?
yeah, I mean,
Are you getting
whenever that
sells there?
happens, I'll
Yeah,
consult you guys as to when that happens. It's been this strong with a strong dollar. I mean, who knows? Which is another reason we always talk about it. We like to judge everything on its own merits.
Yeah,
Watching gold, we would not necessarily have had this allocation to metals and miners.
yeah,
Uh, Watching that, but just the price action in the metals complex itself has been really good. Junior silver miners
yeah,
also have been jumping of late.
yeah,
Another one with major potential still.
yeah. Agree.
People tossed it aside after, it's always when they people, obviously investors are very impressionable and you get a big run, they get excited, people jump in. That's what causes these the down moves. People jump back out. I think there's a lot of room for the not the gold bugs and the diehards. There's a lot of people from more the general investment community to jump back in. So that
You
could
know,
be a
the
lot more
gold
fuel.
bugs, that like physical, a lot of them don't like miners because of recency bias. And I mean,
Mhm.
recency being the last 5, 10 years.
Sure.
They're saying, it always underperforms. You have risk of land grabs. The
Right.
jockey is important who's running the company. You have to do a lot of due diligence. So even gold bugs don't like miners, a lot of them, which
Sure.
I find
And there's,
interesting.
well, I mean, at the end of the day, they are equities as well. So you have the equity component to it. So if the equity market is not in a good place, you could have a great thesis on, why
Right.
metals should be rallying and miners don't follow suit. So that could be very frustrating. So
Yeah.
I
It's
could
all one
understand that.
market.
Sure.
How's the Dow look to you, Dana?
The Dow.
Yeah, the Dow. I know it's
Another
changed.
one. Yeah, it's whatever. It's a flawed average, people say, but it still trades technically like everything else. It's been lagging as far as the large caps are concerned. There's another one. Okay, the 127 extension's been kind of consolidating there since it peaked at the end of the first quarter, along with a lot of the broad averages. You know, Set up now for a breakout. There's another
Maybe.
one. It could easily have an up leg to that 161 extension up around 42,000. Um,
Just
I
looks
don't
like a possible three drives to a top for me. You're right. It could blow off.
Three
Could blow
drives
off.
from where?
Right there, the last section.
From what
Uh,
low are you
no, it's
talking
a
about?
high, a three drive to a high. You have three to the right.
Here?
There's one, there's two, and now we're in
These
three.
three you talking about?
Yeah,
Okay.
yeah.
I
And
thought you meant a
divergent. Well,
longer
I
term
think
cycle.
Ellioticians might call it an ending diagonal.
Okay.
So, I'm taking a shot here. I need a down candle. What's the
This looks
weekly?
more like just the sideways consolidation of this move
Okay.
here to me, which would allow for it would project for one
Yeah,
more move up
42.
here. But I
How
don't
about
know.
the banks? XLF, similar pattern as the Dow.
Similar,
Uh,
yeah. Let me pull a couple of them up. Um, that's another one. Why would you be long financials, I guess, with rates coming down? But
oh,
I would
okay.
be.
So that is a bear case with rates coming down. You don't want to.
Well, my point is, why would you fundamentally, if that's what you believe? Well, I would be long because they're performing well. A couple within the financial sector that we like.
Okay,
Here's the
broker
broker
dealer.
dealers.
That looks a
IAI
lot
would be your
better.
ticker symbol.
Yeah,
Tested and consolidated here at the end of the first quarter. Those highs from 2022 get a nice breakout here. Insurance we've liked for a long time. Another one consolidating since
yeah,
that peak, but those have been monsters for a while. I could see that continuing higher. XLF, similar to the broker dealers, we did have some digestion for the last 3, 4 months. So it's not, I would not call it extended here. I would say there's room to run from
Okay.
this recent breakout here in XLF as well.
Okay. And QQQ, you're just, look at how the Qs look and comparatively,
It's
maybe
it's
there's better bang for the buck elsewhere, and
Yeah,
this has played out.
it's hard to be too negative
Yeah.
when prices are hitting new highs every day. The only factor, like I mentioned, on the Nasdaq 100 is hitting right into that 161 extension. So again, some cooling off here
I'd be
would be
careful if it fills that gap. That would mean exhaustion to me. That could be an exhaustion gap.
fills
So
this
just,
gap.
yeah,
Yeah.
it's
Well,
it's
yeah, and then and that would not surprise me with the 161 extension. This
yeah,
needs to cool off a bit, but the fact that we're seeing other sectors, other equity
yeah,
areas step up
yeah,
in light of that, I think is a very constructive sign. One kind of Hail Mary we've been long for a little bit are these pure value indices, the small and mid cap pure value. Here's the mid cap pure value,
okay,
which yeah, you don't see a lot of small mid cap averages threatening new highs, but this one
yeah,
this is the mid cap pure value RFV.
yeah,
Broke out at the beginning of the year, has been consolidating. And if this one makes another move higher, that could run. This RZV, which is small cap pure value, obviously looks a lot better, a lot different than the Russell. This in our testing historically is probably one of the best barometers of risk on versus risk off that we've seen. When this one is moving higher, RZV is the ticker symbol. When this is moving higher, it's a very good sign of risk on, and it can really move when it does. So this has been storing up for a small cap average, hanging in
yeah,
there nicely. Hasn't really made a move in a couple years, but if this one breaks out and really gets
yeah,
going, we could see a blow off type of a move to the upside before, that major top
okay, yeah. So
starts
we're
in place.
still in the middle of a melt up,
Yeah, and
with your
we
word.
were concerned over the last couple months, given the divergence in the AD line and other breadth indicators. Also, a resurgence over the last couple um, months, over the last quarter in some of the defensive names. So when you see the utilities start moving
Yeah,
again, and healthcare and staples, which they did. Um, it's bullish that, but it's also kind of a late cycle type of a move. So that could be a warning sign. But if
yeah,
you're looking to move into something, a little bit more allocation is something that is not extended, I would look at some of those more defensive names. Here's a healthcare fund, VHT, Vanguard Healthcare, which kind of a cup and handle looking
yeah.
pattern, more of a defensive name, not extended at all. This thing breaks out, it can really run. So that again, that'd be a bullish and bearish sign in the longer term if we see the defensive names start taking over. But while you make some
Great
money
point.
off it in the meantime,
Why don't we wrap it with oil?
oil. I mean, oil is. There are a lot of non-equity assets to me that are kind of just stuck in a range. It's hard to
Okay.
get for me to get too aggressive. It's like the dollar for me. It's
Yeah,
hard for me to get too aggressive, long or short. Here's the GSI crude oil index, which is,
yeah. It's
I mean, it
ranging.
is middle of the road as it gets. So
Yeah,
for us, I guess, pivot wise, it is above a couple of these
yeah.
key moving averages. So I would say
Watching that.
benefit it out to the upside. We are
Okay.
tend to lead long commodity wise in the longer term. If you're looking longer term,
Just
higher
thinking
highs,
that
higher
oil
lows.
producers may want to squeeze us into the election to get the outcome they want.
Sure.
Just a thought.
Yeah.
So you know what? We went around the board. It didn't take 80 days like the movie. It took
Right.
8 minutes pretty much. We had a lot of it covered. So Dana, yeah, you have, since I've been talking about, you have very good feel and discipline in the market, and you know, you're always have an open mind to seeing what could happen by what kind of signals your stuff is telling you. You know, you have your own proprietary measurements that have been working for you. So how could it work for people that are hearing us now or watch the video later?
Absolutely appreciate it, Dale. And we've learned long ago that when you try to do it on your own intuition
Yeah,
and subjectivity, it's a sure path to failure. So we figured out the market's a lot smarter than us. So we're going to listen to what the market data is telling us, and we try to keep it objective and quantitative. So that's helped us a lot. Our main, as you asked, our main business is a registered investment advisory, J Lyons Fund Management, where we do client management. We also started this trading service a couple of years ago, the Lion's Share, for folks that want to follow along with our thoughts and our models, but want to pull the levers themselves. The Lion's Share is the name of our trading service. We give you a daily update on what we're looking at, as well as sending out alerts of all the trades that we're making. It's up to you to pull the levers, but good way of following what we're actually doing if you don't want to be a managed client. So you can find us here at lionsharepro.com. Like I said, we also have management service. You can find, I still call it Twitter. Find us on Twitter at J Lyons Fund Management, right there. And always a pleasure being on, Dale.
you
This is
know,
one of
it's
the
a
best
great.
shows that I do, and
Yeah.
you've got a wealth of knowledge, and your listeners would be very, very wise to follow your lead and those of your fellow commentators.
All right. Well, I appreciate that, Dana. And to the left of the screen, you're showing where I lived when I went back to trade, Marina City.
Right. You
You
mentioned
know,
that.
I
Yeah.
don't know I forgot what floor I was on, but I didn't jump. Although it was New Year's Eve, and I called the airport asking to go anywhere warm, and I couldn't get out.
Uh, well, that's
Anyway,
why a lot of people leave Chicago.
you know what, guys? Diversify away from yourself, because we all know, especially for discretionary traders, that we all have our runs, and you know, to diversify away from yourself could give you balance when you're going through those periods. So check Dana out. I think his work is elite, and he has the right temperament for doing this. A lot of people don't. So thank you, my trading warrior brother. Appreciate you.
Always a pleasure. Thank you, Dale.
We'll talk in the fall and see if some of these parabolas change their shape a little bit.
It'll be interesting.
It sure, yeah. We're definitely cursed to live in interesting times.
Yeah,
All right.
indeed. All right, my
Take it
brother.
easy.
Take care.
Take you too, Dana. Dana Lyons, everybody. Find him on X at J Lyons Management. Check him out. Dana's very good. And that's a wrap. You could join the team in 10 minutes on the Morning Edge. Thank you, Laura. Glad you enjoyed. Marcus, you too. Remember, don't just count your pips, count your blessings. Have a good turnaround Tuesday, and we'll see you tomorrow. Good hunting. I believe I have Pedro da Costa tomorrow. Looking forward to talking to him, because he recently did an interview with Sheila Bear, and Sheila saw a lot of things coming before the markets did. So it should be a great interview. See you guys tomorrow. Adios. Thanks, Dana.
You got it, buddy. Take care, Dale.
You too, bro.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.